Hello, and welcome to the Alliance Wealth Advisors podcast. I'm your host, Mike Cadaro. On this episode, our guest was Jim Jackson. Jim is the co-chief investment officer of Victory Income Investors, which was formerly known as USAA Investments. Before entering the investment business, Jim served in the United States Marine Corps. He holds a degree in economics from the U.S. Naval Academy and an MBA from the University of Michigan. He is also a CFA charter holder. In this conversation, Jim and I discuss his career path and how he was the first person in his family to attend college. He tells the story of how his career in finance started on an aircraft carrier and the role curiosity and luck have played along the way. He also gives advice to those seeking to make a change in their career with what aligns with their true interests. While we do go into the weeds of fixed income investing at times, this conversation is not just for people interested in the complexities of things like bond math or monetary policy. First, Jim explains what fixed income actually means and the difference between a bond and a stock. From there, we take a broad historical view of interest rates and discuss how the last 40 years of declining interest rates have influenced people's decision-making and how the magnitude of the Federal Reserve's interest rate hikes have caught people off guard. We also discuss the current narratives playing out in markets today and look ahead to potential risks and opportunities. Admittedly, this is a longer episode, but there was so much I wanted to ask him. We were able to get Jim's thoughts on the important conversations we are having with our clients. We hit on everything from the difference between a bond and a stock to the risks of holding too much cash in a portfolio today. We also discuss how to think about growing concerns over U.S. government debt levels, why negative news can make it hard to stay focused on the long term, and the one question anyone with a portfolio should be asking today. Jim also shares his team's investment philosophy and explains why they spend very little time trying to make predictions about things like the economy or the direction of interest rates. Instead, their focus is on continual improvement of their process and focusing on only the things they can control. Interestingly, this even extends to how Jim spends his personal time, where he avoids watching financial news on television altogether. Our entire team learned a lot from this conversation, and I think you will too. It was an honor to have Jim on as a guest. Thanks again to him for sitting down with us, and we hope you enjoy this episode. Jim Jackson, thank you, first of all, for taking time out of your day to come on to the Alliance Wealth Advisors podcast. We really appreciate it.
No, this is great. Thanks for having me on. I'm looking forward to our discussion.
So I think, there's a lot we want to get into in terms of the fixed income markets. Obviously, that's been a really big area of interest, not only for our clients, but I think, on Wall Street in general, given everything that's gone on over the last few years, right? But what I like to do in this podcast, and this is cool for me because it's a little bit of a different subject matter in terms of what we'll talk about today. But where I'd like to start is something I always want to do with guests is help listeners understand who you are and how you sort of got to the role you're in today with Victory.
Sure. Well, my current role, I'm the co-chief investment officer and head of fixed income portfolio management for Victory Income Investors. So we are an investment franchise for Victory Capital. So we're the fixed income asset manager under Victory Capital. So I've been with Victory since they purchased USAA Asset Management in 2019. I was at USAA since 2009 after spending several years each at Hartford Investment Management, a few years at Barings, and starting my career in the business at seismic and in Hartford. So, and really starting at Cigna was a great start for me. It was really just a great team of people, really a great group to learn from. So that was really sort of, when you always look back on your career, you kind of look back to where you started and how great of a launching pad that was. And I was certainly fortunate to have that foundational experience. prior to entering the investment business, I completed my MBA at the University of Michigan. For the 5 years prior to that, I was a Marine Corps officer. I graduated from the Naval Academy in 1994, and I grew up in Marcus Hook, Pennsylvania, which is in southern Delaware County.
So you're growing up in southeastern PA. You have, what I would imagine is a bunch of options coming out of high school. What led you to choose the Naval Academy and, the Service Academy route more broadly?
Sure. Well, just like most things in life, you get kind of lucky by getting the right advice at the right time. So not a lot of kids from Marcus Hook go on to college. It's, my whole family's from there, and I was the first one, right? So
wow.
I didn't really know much about sort of options, how to take advantage of them. I'd always been sort of a very good student, very involved in my school, playing sports, things like that. And when I was in ninth grade, my English teacher told me in class one day that really I should think about one of the service academies. I didn't really know anything about it. I hadn't even heard about them as far as an option for me. So I really explored what they were about. Got in course of that, I became singularly focused on it. Right. So I took the hardest classes my school had to offer. I did all the things I thought that I needed to do to enhance my chances of getting in. So when I was applying to college, I applied to, I think it was 5 overall schools, but 3 of them were service academies. Navy was always my first choice. It was the only service academy that really offered a direct path to the Marine Corps. Like that was a Marine. I felt it was just something that was very much a goal of mine, and that's what led me there.
I'm sure your parents were really proud of that, especially being the first one. That's a heck of a first go around with college. It's the U.S. Naval Academy.
My dad was certainly, my dad, he was a Marine. He was in the early 1960s, and got out as a first class or something like that. The day that I graduated, I think it was a big sort of day for him too.
That's great. And so you spent how long in the Marine Corps after the Naval Academy?
5 years.
Wow.
After I graduated, probably a couple of weeks afterwards, I went to the basic school, which all officers in the Marine Corps go through. It's a 6-month training course in Quantico. From there, a few months in Camp Lejeune. And then I spent 4 years in Yuma, Arizona, which is basically 3 hours east of San Diego, 3 hours southwest of Phoenix. As you can imagine, given that it's really in the middle of nowhere.
So going from that military life for 5 years, that's really, at that point, that's all you've known, right? Going into the academy at 18. What was that transition like? And how did you think about, okay, well, I'm going to get into the investment world. How does that play out? Well,
I'll have to dial back the clock a little bit on that, I think. So, when I went to Navy, I think as most kids going to college, you have an idea of what you want to major in. But the reality is you really don't know anything. I think I showed up there. I said, well, I'm going to be an aerospace engineer. And my plebe year, I said, well, I'm going to be a history major. And I started out as that. And I was, so the end of my freshman year, plebe year, is what it's called there. You do what's called a youngster cruise. So I was out on a boat. I was on an aircraft carrier for 6 weeks during that summer. And, I didn't really know what I was supposed to be doing, where I was supposed to be. I was just really trying to not get in anyone's way. And but you're looking for things to do, right? You're not working all the time. So generally go to the gym so much. So I was like, well, I'm going to do a lot of reading. And, I started there was something as simple as one of the sailors had left a money magazine or something out on the counter. And I said, well, I kind of read everything there is to read. And I was like, you know what, this is intriguing to me. And I spent sort of the rest of the summer learning about it. Actually went back to Navy, changed my major to economics.
Wow.
And I was very fortunate to have a class that the title of the class was financial accounting, but it turned out not to be entirely that. So the teacher of the class basically had every student read A Random Walk Down Wall Street, and we did a big project around that. Mm-hmm. Sort of experience really changed my life. It sort of really said, well, maybe, I think up until that point, I said, I'm going to be 30 years in the Corps, and this is what I'm going to do, right? And this was sort of opened my eyes to other things that are out there that I simply had no idea existed. I said, okay, if I'm not going to stay in, what am I going to do? And really the first step was I think I need to go back to business school. The second step is, and I didn't really learn this till I was a few years, maybe a year or so before I get out, is to start taking the CFA exams. So I started to take those. Actually, I finished all of them before I even entered the business. So, wow. So the transition for me, so that was sort of the backstory, but the transition for me in getting out was pretty smooth. I knew I was going to business school. I had a rough contours of an idea of what I wanted to do. Plus an MBA program like the one at Michigan. I mean, it's an excellent school, excellent career resources. The recruiting there is excellent. So I really felt very fortunate to have gotten in, right? And then been able to go there for 2 years was such a great experience for me. And I think really helped me sort of understand what my options were even further and sort of start me on this path.
It's really interesting how, I've heard this to different degrees before the guest, but this information, whether it was the magazine on the ship, right, or a random walk down Wall Street being part of a class after you switch because of that, where these things sort of hit you in the right time to resonate with, what was just curiosity at that point. It wasn't something you felt you had to do. It wasn't a path of, well, I need to, I can't study history. What am I going to do with it? It was just, no, this is interesting. And so I'm going to pursue it.
Yes. It's, I think sometimes just being lucky, I think people underestimate how big a part of the life that.
I agree. And so this leads to a question I had in meeting with you and your team, and we've been lucky enough to meet with your group a few times now. But I think, the passion for what you do day to day comes through, I think, in a really authentic way. And I have sat through, over the last 13 years, I've sat through a lot of meetings, particularly fixed income meetings, where, it was not the most, I'll say it this way, it wasn't the most engaging hour of my day, right? And I think in sitting with your team, that's not the case. You can tell, you guys are engaged. Your team is fired up about what you do day to day and the way in which you do it. And so, where does that come from? When it comes to just why and how much you enjoy it. And then my second question would be, as a follow-up, we talked a little bit about how your path went. Do you have advice for people to maybe find that luck a little bit easier for those listeners who are, considering a change in their path or maybe doing things that they're not completely passionate about right now?
Sure. I'll start with our team. I think I'll really start with, personally, what I enjoy the most, right, is not necessarily, I obviously manage bond funds and ETFs, and that's great. And I enjoy that. But the most enjoyable part is just leading the great team that we have, focusing on continually improving our process and our business, and really in the furtherance of delivering world-class products to our clients, right? So I think that is a core part of the culture of our team. And really what that mostly comes from is our history, right? So the asset management business, we were founded 1970, so 50 plus years ago. And really it was designed to manage money for USAA members and their clients. So for those that don't know, USAA serves this sort of service persons, that's their primary clientele. So that was the reason that I really moved from the East Coast out to San Antonio. And I think what that formed culturally is that we care deeply about our clients, delivering the right products for them, doing a good job for them, and that our focus every day is to communicate how we manage our products, construct our portfolios consistently according to our process, and deliver that consistently to our client base. So I really think that history that we have has sort of built that culture for our team. And I think that's just a core part of who we are.
Do you think to talk about that, the core client that USAA had for so long, and obviously that's changed to a certain degree now, but knowing this is who we're managing these assets on behalf of, you're not chasing flows, and not to get too inside baseball here for, non-investment listeners, but the fact that that these are your clients, these who we're managing, future liabilities for, and not having necessarily to quote unquote sell, but to serve. Does that make you a better investor over a long period of time?
I think it does, because let me just give you an example. So as far as how we think about things. So we have a process in how we manage bonds. The process has been honed and built through 50 plus years of experience in doing so, right? So we have a really concrete idea of how you can win in fixed income over time. We built a core competency around that, and we simply run that process over and over again. What we don't do is we don't deviate from that and start to engage in activities that are inconsistent with the competencies we've built over time and that we think are not reliable sources of fixed income alpha. So an example would be is we don't think that you can forecast interest rates, the macroeconomic environment. We think that the one thing that's been proven over the last few years is that macroeconomic forecasting is inconsistent and reliable, and that's being generous.
And people love it, especially this time of year.
I think when folks do that, I think it gives people comfort. Oh, they know what's sort of going on.
Sure.
Where this is going to go. And it gets a lot of clicks, gets a lot of attention, those sort of things. But we always come back to what we know, or at least what our experience has taught us in fixed income. And it's really three things. One is that the starting yield, the yield at which you buy a fixed income instrument, is highly explanatory for the annualized return over the life of that bond, right? So yield matters. Number two, taking credit risk, meaning buying corporate bonds, asset-backed bonds, wins over time. So doesn't win all the time, but over time it does. And then third, interest rates are not predictable. And that really, we view those as sort of building our process on top of those things, and knowing that has worked, what has worked over time, something that we can explain to clients, we can explain to folks that hire us so that they understand what we're doing. We think that's important for us to do. So, we're managing portfolios looking to outperform our peers over 3 to 5 year time periods, right? We're not looking to outperform this quarter, this 1 year, those sorts of things. We know what works over time. We know we're confident in our process. We're confident even more in what we don't know. And we sort of just, staying consistent to that process, we think is a key to long-term success of our team.
That circle of competency and staying within it can be a challenge, right? Especially given, the way incentive structures often are in our industry, right? And that's something that's come up a lot recently with Charlie Munger's passing. But that idea of saying it and it sounds great, right? We're gonna screen everything through these 3 foundational principles, and we're never going to go outside of our sort of area of expertise. Easier said than done, too.
Of course. And I think, my job, I think one of the biggest parts of my job is to making sure we do that, right? And those sort of things inform how we build our team. Every portfolio manager on our team was on our research team before. We don't have any meetings to forecast where things are going. I mean, everything that we do, the structure is built around reinforcing our process.
So as a leader, to get back to the second part of my long and rambling question, as a leader and as someone who I'm sure has these types of conversations, whether it's people who are working, with you on your team or trying to get in the industry, just younger people in general, how can they take, one thing that you've learned to help themselves find that direction? And I think one thing that's shown up for me in interviewing other people I had mentioned that shows, through your story so far, at least, is this idea of just curiosity, right? If you picked up the book or the magazine and you didn't put it down, like that's probably a decent sign that that's authentically interesting to you. But what do you tell young people trying to find that direction in their careers?
Sure. I think, I would be less focused on anything that targeted. I think that make sure you read a lot of different things, open yourself up to new ideas. The worst thing you can do is sort of close your mind off to something new. Right? I'd say most importantly is sort of whatever you are doing, be focused on being really good at it. Right. So I think people tend to like doing things that they're good at. So they may not have thought they were going to be good, or they may not have thought they would have liked something. But if wherever you find yourself, you focus on just being good at what you're doing, it's sort of a habit, right?
Yeah.
So whatever I'm doing, I'm going to be good at doing it. I'm going to figure it out. That habit sort of will apply to the next thing and the next thing.
Well, in a weird way, though, the next thing opens up when you focus on what's in front of you too. That's something I had to learn the hard way as when I was younger.
Yes, absolutely. So, I've always find myself doing a lot of different, when I was in the Marine Corps, doing all kinds of different things. And, I always focused on what is the end goal? How can I help us get there? And try to do the best, learn as much as I could, do the best I could to sort of further what my team was trying to get done.
There's a lot to be taken from that, I think. So pivoting to markets, one thing we try to do as a firm is we really focus on the way in which we communicate to clients and prospective clients and frankly to one another, right? And I think there's a lot of complexity, there's a lot of jargon in our industry. And so we're trying to help people make better decisions. And that means you got to meet them where they are, regardless of their, if they are a portfolio manager, managing $2 billion in fixed income assets, or somebody who's trying to figure out how to get their kids, through college, whatever the case may be, those same principles have to be communicated effectively. And so given that kind of context, I guess, can you give listeners just a high level overview? What is the fixed income market, and what is your role within Victory, working within fixed income and bonds?
Sure. So the fixed income markets really consist, first, fixed income is a source of capital for companies, governments, people, just, to get a mortgage, to fund the building of a bridge, to build a new plant, and for owners of capital, they can invest in fixed income. So the fixed income, generally the form that it takes, it can either be bonds, it can be a loan, it can be those sorts of things that are issued, across the globe. So the U.S. has the largest fixed income markets out there. I think it's estimated to be over 50 trillion. So this would include U.S. Treasury bonds, corporate bonds, agency mortgage bonds, just to name a few. So whoever issues these bonds, they obviously come to the market, they issue bonds, they get cash, and they use them for whatever reason they're going to use them. So really, if you're looking at just broadly on the global markets, there's stocks, right? They can use those for the same thing. They can issue stock, get cash, put it into whatever use case they want. However, stocks represent an ownership, whereas bonds are basically you're lending money to them. So there is a contractual agreement. You give them $100, they're going to pay you so much per year, and then give you your $100 back at the end of the term. So that is sort of just two ways for an entity to raise money. You can either issue stocks, they can issue bonds or take out loans. The difference between the two is one represents ownership, the other basically lending with a contractual agreement to get paid back.
That's great. I think breaking that down as simply as you did, and having the ability to do that, it's really important when people are looking through their statements, right? And we always say, like, know what you own and know why you own it. And I think fixed income, you're trying to create some predictability in terms of the cash flow coming in, and at the end of the day, somebody owes you something. So one thing I have talked a lot about, or written about at least, since I joined the firm a few years ago, was just the power of interest rates on as sort of a domino effect to everything else when it comes to making decisions. And Howard Marks has written about this recently. It's just this idea that it's kind of like the two fish in water, right? Somebody and an older fish goes by and says, "Hey boys, how's the water?" And the two fish are like, "What's he talking about?" Whereas most people are making decisions not realizing we've been in a period over the last 40 plus years of declining interest rates. And that may or may not be changing today. But this is one of the reasons I wanted to have you on, was to help people understand it, because I think, certainly for my entire adult life, but people, even much older than me, they've really only seen interest rates go down. And that has seeped into the way in which people are making financial decisions. Would you say that's a fair way to put it?
I think that is fair. Yes.
And so can you walk it through, from sort of my idea here was we'll start at 30,000 feet with this, interest rates at a high level, and then get down to the individual, and how they can maybe make decisions. But how do you view, some of what I just said in terms of, the 1980s our our parents and aunts and uncles are quick to tell us, when I got my first mortgage, it was 18%. It was, it was 19%. CDs were paying 22, which is just crazy to think about. And then to get where we were just a few years ago, where things were zero. So how do you, as a fixed income investor, how do you view that last 40 years or so, and what drove that in a nutshell?
Sure. Well, yeah, let's start with what are interest rates. I mean, I think a simple explanation for that is basically the cost of money. So it's basically if someone gives you $1 today, what do they want to get back tomorrow that compensates them for the risk of not having the money in their hand now, right? So it's basically what's going to drive that is the macroeconomic environment where inflation is going. There's a bunch of sort of different things that drive that. So if you dial that back to the late 1970s, early 1980s, inflation had been elevated for quite some time, and it started to peak in that time period. Rates did not necessarily keep pace with that until the early 1980s, when rates were increased significantly to bring inflation down. So that really kicked off what's been termed the 40-year bull market in bonds. So what happens when interest rates go up is, all else being equal, bond prices go down, because if you have new bonds being issued at a higher interest rate, you have to lower the price of existing bonds to sort of compensate people for that. So what you saw really over a 40 period with rates coming down, obviously bond prices generally would have gone up during that time period. Now, there was a big decline, obviously, in the early part of 1980s. So that's one sort of aspect of it. And that, I think, is etched in people's minds. You mentioned your parents saying, my first mortgage was 18%. Late 80s, 1990s, it moved around quite a bit, generally going down. But I say the real change in the market and really in people's psyches really started after 2000. So I recall, when rates were moved, when the Fed funds rate was at 1% in the early 2000s, and it was like, how long can I say 1%? It's going to be inflation, et cetera, et cetera. Didn't really happen. But rates were kept low for a long period of time. But then the real game changer occurred 2008, 2009, where crisis hits. There was just a significant decline in aggregate demand during that time period. The Fed loosened policy significantly. The banking crisis, typically when those happen, the level of demand stays low for a long period of time after that. I'm meaning sort of demand in the aggregate. So rates were kept low for a long period of time, pretty much after 2008, 2009. Now, what also happened for most of that time period, so if you look 2008, 2009 up to pretty much 2021, bonds were negatively correlated to stocks, right? So even though yields were low, if you were holding a 60-40 portfolio and your stocks went down, generally what you saw is bonds went up, right? So it was serving a great role. You weren't necessarily generating a lot of income from that.
Right.
However, you were benefiting from the ballast that bonds provided. So I think there's one aspect from an investor standpoint. They had that recent experience where when stocks went down, my bonds went up. They weren't necessarily focused on, well, they were, but I would say that that sort of minimized the concern about yields being so low.
Right.
Now, from an institutional standpoint, so if you had insurance companies and pension funds, they want to generate income. And so with rates really low, that was obviously challenging for them to do. So you started to see other sort of asset classes meet that demand for income. So you saw more private debt, leveraged loans, things like that, sort of come to the market to meet that level of income. Now, so I think that's sort of the environment that we saw, 2008, 2009 through 2021. And I think coming into that time period, it had been 12, 13 years where rates were really low. So that for most investors, that was their experience.
Mm-hmm. Mm-hmm.
So when 2022 hit, you had a combo really of rates being really low. So there was minimal cushion from income to mitigate any decline in bond prices if rates went up, right? So I think the market was somewhat surprised. The magnitude, so you have rates being really low. The magnitude of the rate increase was obviously extremely high. And you saw bond prices really experience in 2022 the largest decline that they have seen, certainly in any recent time period. So if you look at the largest index, the Bloomberg US aggregate, 2022, it was down 13%. The largest annual decline prior to that period was 2.9%, just to give you a magnitude, right? So, that really, as we kind of have seen yields go up, it certainly I think it was inconsistent with the recent experience of holders of bonds. And it sort of really, I think the general understanding was that, hey, if stocks went down, my bonds are going to help me. And that did not.
Yeah. It was a cold bucket of water over the head in 2022.
It was. And it's, I kind of think of it, when, and really 2022, we kind of viewed it as much more of an outlier as well, right? I mean, it's unusual. So if you look over the last 50 years, there were 11 years where stocks were down. In 10 of those 11 years, treasury bonds were up when stocks were down. In 8 of those 11 years, corporate bonds were up when stocks were down. And in 2 of those 10, when corporate bonds were down, low single digits, right? So the only exception over the last 50 years was 2022. So I think when you think about holding bonds, they do most of the time provide that support when stocks go down, just not all of the time, right? Yeah. And I think a big part of that was simply when you're starting from an ultra low yield environment, the interest rate risk is high, and the yield cushion is low. So that's sort of what the experience was. But I think that times have changed certainly since then with yields up, even though they've come down somewhat, yields are up quite a bit. And I think that's an important factor because the yield cushion is meaningful for any sort of to really mitigate the risks of if yields go up further.
Talk about the yield cushion.
Sure.
At, just for, I'm thinking of, clients getting close to entering retirement, we're sort of just managing the time horizon with which they may need the money, right? Against not only the yield curve, but the psychology of managing that, right? And so the cushion that's provided at 5% versus 2%, what does that mean for a portfolio?
So let me just give a quick example, right? So let's say you have a bond that's $100. It's a 5-year bond and interest rates are 1%. So if rates increase 1% to 2%, the price of that bond will fall 5%. However, your yield is only 1. So your return over the subsequent year will be roughly minus 4%, right? So okay. 100 to 95, you only generate $1 of income. So you can see the challenge when rates are low. So let's flip it to the other side.
So we're at 96.
So yeah, so you end up at 96, Now let's just say, let's assume the yield is 5. So we assume the same $100 bond, interest rates are 5. same term, 5 years. Rates again, say they go from 5 to 6. Okay, so that bond goes down the same 5 points from 100 to 95. However, you're generating $5 of income per year. So your total return is roughly flat.
Right, 100. Yeah.
So I think the higher yield really serves as a mitigant to rates going up. And certainly at the end of 2021, you did not have that. Right.
Yeah.
And I think that's important to understand, because what we've seen with flows, right? If you see, this is across the whole space. So I kind of look back at this over the last couple of days. So some of the strongest flows we saw in fixed income were in the early part of 2021, when the 10-year was yielding 1.5%, right? When the 10-year was yielding in October right around 5, flows were negative. Right? So I think it's when yields are going up, the probability that's a very explanatory for expected returns going forward. So it's a more opportune time in our view to add fixed income exposure. But the behavior we've seen of the market doesn't quite match that.
And so this is an interesting question on that point. So, the Fed, you could argue, stayed low for too long. The fire hose was on fighting the fire, arguably, after much of it at least had been put out. And so they were buying mortgages, interest rates were at 0%. And I think there was this recency bias in the market that, they keep saying they're going to raise if they have to. They keep saying they're going to raise, but they're not really going to, we're not going back to 5%. Like that expectation you talked about, because of what not only just the last 12 or 13 years look like, but maybe more like the last 40, but particularly since 2008. And so did that catch people off guard? And frankly, was the Fed caught off guard to some degree?
I always I kind of put the Fed in the category of everyone's job looks easy when you're not.
Yeah. It's like I watch Penn State with some family members from time to time, and it's amazing what experts they are on running a spread offense.
So I do give them some sort of leeway, is that it's a complicated job that they have to do. If you kind of roll back in the time period when they were trying to balance, a bunch of different things. So in hindsight, yes, they were too late. But I sort of look at it as like, well, there was a balance of risks there. It's easy for us to sort of look back and say, well, they waited too long.
Right.
Because we don't, there was a range of outcomes that they're sort of looking at, and it just happened to take the path of, higher inflation. But that at that time was not a certainty for sure.
Yeah.
Right? So,
and now you could say that, and not to get too into the weeds here, but team transitory, you could argue they were right, maybe, depending on what happens here in the next couple of years.
Well, I think what we've seen is inflation come down pretty consistently. Not quite as fast as it went up, but not pretty close, right? And it's sort of recently, but yeah. So and the two, I think we have to acknowledge that, if we look back at that time period, and how we got to where we were, really it was a sequence of just unprecedented events, right? We start with the onset of COVID, material decline, and demand fell off a cliff for like a month, right? And then when it came back, it shifted dramatically. So we really experienced at that time that demand shifted. No one was going out to dinner, but they were buying bikes. Really shift from services to goods. Spending by the government went up. Everyone sort of knows this, and then the Fed reduced rates really to the floor. So really what they were trying to do, this is very uncertain. No one, if you think back of March, April, May, June of 2000,
just crazy times.
Crazy time. So really the Fed at that time was just looking at, they were trying to support the economy. Unemployment went up significantly. So that was certainly, I think, an understandable reaction to that environment.
Oh, for sure.
So now when the economy started to open up a little bit, we talked about there was an increase in goods versus services. That strained the supply chain. COVID actually contributed to supply chain bottlenecks, labor shortages, et cetera. So we had a period where goods demand went through the roof, and monetary policy was still loose. A lot of government support for the economy combined with those shifts in demand, inflation started to move up, right? So, and it really started to move up, I think, much faster and more persistently than the Fed was expecting it to, right? So yes, they were in hindsight late to the party, but then they really reacted with the fastest rate increase we've seen in recent times, right? So really the reaction was, yes, they were trying to play catch up. You would argue too that what we've seen is that they've had a lot of success in bringing inflation down. But that sort of whipsaw, I think, sort of, and the rise in interest rates and the impact on bondholders, I think it sort of invites a lot of recency bias to that experience, and not, and I think that's sort of what has resulted is what we're seeing in the market, like record amounts held in money market funds and things like that. That invites sort of its own set of risks as well.
Yeah, so I want to get to that point on the money market funds, because it's a huge conversation, not only for us, but I think across, I talk about investors from 22 to 92, right? Everyone is having that conversation in one form or another. Before we get there, because I think when we're getting together here, it's, we're getting close to Christmas. And last week, Jerome Powell spoke, and the regardless of what he said, what the market heard was, we're off to the races, baby. We're gonna cut in 2024. We're going back to 2019, and risk assets, just took off. And to me, it feels like this is the latest iteration of there's narratives that are just doing battle in the market right now. And it's higher for longer. We are not going back to the 1970s. This is not Arthur Burns' Fed, right? And that recency bias of, look, this is a blip. Rates are at 5, 6. They're not going to be here long term, and markets are just dying to pin the Fed at the corner to cut. And that seems to be a lot of what's going on when you're watching the market react to headlines as dramatically as it have. Now, do you agree with that? And so I'll start with that. Like, do you think that that's a fair way to put exactly what's going on in markets to end 2023 here?
Yes, I think I think there's really, what we're seeing is sort of really a push and pull versus the magnitude versus what the market is trying to price in with regards to the magnitude and the pace of the Fed cutting rates, right? So anytime you see the 10-year Treasury drop 100 basis points in, a month or 6 weeks, right? That is a significant move. And really, if you think back to October when rates were at 5 on the 10-year, there was a lot of chatter. They're going to the moon because of the deficit, et cetera.
Return of the bond vigilantes, right?
Yes, it was all kinds of things. And then promptly rates fell to 4, and you don't hear so much from those. So I think what to us is just further proof point that, forecasting where rates are going is not a reliable way to generate fixed income returns. You're really just sort of guessing. I think it's probably best for everybody to acknowledge that.
And I think it expands well beyond fixed income, Jim.
True. But so I think that's what the market, it's right now, so let's just think about where the Fed sits, right? Inflation is coming down, still above its target, pretty consistently coming down. And some of the other indicators suggest that it will continue to sort of tick down. Now, I think the Fed is just not wanting to repeat the mistakes of Arthur Burns, right? You referred to him, right? To keep inflation sort of coming down closer to their target. I think also the Fed knows that historically inflationary episodes take multiple years to really to bring back the previous.
Yeah, just to fully digest.
Exactly. So there was, I think over the last several months, there was an IMF study that looked at 100 inflationary episodes across the globe. And 60 of those, inflation was brought back, roughly to its previous level. The one consistency amongst all of those was monetary policy was tighter for longer. And on average, it took 3.5 years to bring it back to close to its sort of previous level. Of the 40 where inflation did not come back to its previous target, the one consistency is that monetary policy was loosened too soon. Right. So I think that I read it. I'm sure the Fed.
Yeah, they've read it.
So I think that I think that's the narrative we've been hearing from them is, hey, we want to make sure that inflation is under control for good. And we're not going to loosen until we're confident that that's the case. Because we know that one of the worst things that we can do is to start to loosen and inflation start to pick back up again. But the market really is pushing back and forth with regards to sort of the magnitude of the pace in which they're going to do that. But I would also point out that the market pricing of that has been historically just terrible, right? So it's I would just point to the end of 2021. The market was pricing in a Fed funds rate at the end of 2022 of less than 1%. Mm-hmm. And it ended up between 4.25 and 4.5, right? So even though the market is pricing those things in, we acknowledge that, we understand why they're doing it. We don't put a lot of stock in that. That is a certainty that that's where it's going based on what we've seen historically as far as the market pricing those cuts in.
So to get to the money market fund piece of that, what you had mentioned earlier, I think we are talking about it all the time. And one thing that we've seen for the first time in my career, which started in 2010, was like, especially for those in retirement or on a fixed income, CDs have been great. CDs and fixed income in general, but money markets, right? They're not just a sort of placeholder. They're generating returns for that portion of the portfolio. And I think what I worry about, and when I'm having conversations with clients, it's in a world where everyone is short-term focused to the points you just made. People are increasingly negative in this sort of news, social media, constantly plugged into the phone environment. And so when people are constantly feeling like things are challenging, and not to say they aren't, but we're certainly, sentiment is overly negative right now when you look at historic sort of data, right? So a lot of people are saying, oh, that 5%, that feels really good when my head hits the pillow. And the thing that we're trying to explain to people is absolutely there is a place in the portfolio for cash in many cases, but there are risks there, and frankly, the risks are, those are real, and they can make a big difference to the, as you mentioned, the range of outcomes for your retirement or for your portfolio. Can be pretty wide depending on how you make those decisions. Can you talk about how you think about that as a capital allocator?
Sure. Yes, it's certainly understand folks' concern, obviously, with the experience in 2022 with cash rates a lot higher. I guess I would start with, how we should consider the role of cash, right? I think there's basically multiple layers to that. Obviously, cash is used for sort of operating, expenses, right? Just paying your bills. If there's a reserve fund would be a good role of cash. When you start to roll out like, hey, this is money I don't need like right now or the next year, then you start to move into maybe I hold it in like a shorter term bond fund or something like that, right? So I think you have to be clear like what the role it's trying to play, because there's a real opportunity cost to cash. And I would really put that under two things: is that one, peak rates tend to not last long, right? So the cash rates that you're getting are only for the time period that rates are that high. They tend to turn over fairly quickly, and historically rates have not been at their peak for a long period of time. And the two, that over the long term, cash pre-tax barely keeps up with inflation,
Yep.
right? So I think those two things are worth thinking about. Now, I would really characterize those risks if we're going to put them into some sort of bucket. The first would be reinvestment risk, right? And that's it. Cash rates don't stay high for long. Is it time to lock in some of these higher?
And Jim, so what? Sorry to interrupt. What you mean there is that 5% in a really short amount of time can go to 1 or 2, and history would tell you that wouldn't be a crazy move in a short period of time.
No, and I think it's like when the Fed cuts rates, that's reflected in money market funds in short order, right? So the impact is, in the bond market, that's reflected over longer time periods, right? In the money markets, it's almost immediate, right? So I think that there is that risk that that those yields can be fleeting, and that in short order, they could be, just much lower than you would expect. So historically, I would caution, holding a lot of excess cash, simply because that higher yields that you're getting now historically don't last for a long period of time, and that you will have to reinvest those at a lower yield as opposed to locking in higher yields for a longer period of time. Characterize it under is like holding cash invites purchasing power risk. So as I mentioned, on a pre-tax basis over long periods of time, cash barely keeps pace with CPI, right? So I think if that's a core strategic allocation and it's a large amount, after taxes, you invite sort of trailing prices, right? So there's a sort of risk with regards to purchasing power. And the last thing I think, if you're hiding out on the short end, you're effectively trying to time the market. Like, when rates are going to start to come down. And as you can see, the front end has still remained fairly high. The longer end of the curve has started to move down already, right? So that will price in earlier. And really what you saw in November was returns in fixed income. So the ag, I think, in November was up 4.5%, which is almost equal to an entire year of income in a money market fund.
Yeah.
So I think that by hiding out on the short end, you are market timing. And as we talked about it, earlier, we don't think market timing is necessarily possible. And we certainly don't think that you can predict where interest rates are going to go or the magnitude and speed in which they're going to change.
Yeah, no, that makes a lot of sense. I think effectively breaking it down to market timing is really important, because the same people who would not do that on the equity side, they may be doing it on the fixed income side, but you may do it. You may do it to the same result. I think Ben Carlson is a writer and investor I read, and he called it a cash addiction, right? So, markets are going up. Well, I got to hold on to it. This isn't a good time. Markets are going down. This isn't a good time. I better hang on to it. And at 5% interest rates, when that has not been, you haven't been able to get paid on cash for well over a decade, I think you're seeing people kind of work through what goes into that quote unquote cash addiction approach in an uncertain environment where there's a lot of tail risks.
Sure. I would say that the environment is always uncertain. I would posit that the biggest risks in the markets over the next 5 years are ones we're not even talking about.
Absolutely. Right.
And so that's why when we invest, and I think this applies to an individual's portfolio as well, we know that there's a lot of risks in the market. So what do we focus on? We focus on what we can control, and that's our process. Relying on our fundamental credit research, weighing the odds in our shareholders' favor as far as where we allocate to take risks, delivering the interest rate risk profile embedded in the product and not making bets on rates. I mean, that's the process that we run over and over and over again. From an individual standpoint, for them to achieve their goals, the process I'm sure that you follow is generally like, here's your risk tolerance, here's your asset allocation across a bunch of different asset classes. We don't know which one's going to outperform, underperform. It's best to have this balance, and then run that playbook time, right?
Yep.
Is your friend. And when you deviate from that, it tends to be when markets you think are uncertain. You're scared certain things are going to go down, or short-term yields are high. That's where the value is. And I would question whether any of those are sufficient to overcome or overrule the plan that you put in place when you were thinking calmly through it, right? I think the worst time to make a decision is when you're under duress, right? This is probably a lesson from the Marine Corps. Is we focused on process. Keep it simple. Whatever. Everything you do, we practice, we repeat, we have a process, you go over it so that when the situation is most stressful, right? When you're tempted to just react to it, you follow the process.
Yep.
Right. And I think that is an underappreciated value that you provide for sure. But I think when folks spend their time watching the news or doing anything like that, it kind of, forces them to think they might need to deviate from that because of all these other things in the world. Focus on what you control. Says rinse and repeat.
Yeah, I love that. And one of our quote unquote foundations that we always introduce to clients is focusing on what you can control. You can't time the market, which you mentioned. And then the other one is there's no such thing as a free lunch, which I think applies right here too.
Absolutely.
So as financial planners, we're having these conversations where, a lot of it is about duration, and it's, that's an investment term. But for us, it's maybe used slightly differently, but at the end of the day, like, our goal is to ensure the time horizon in which we may draw from the portfolio matches how the assets are invested, right? And I think when you look at people saying, I got burned in the stock market in 2008 or 2000 or in 2020, like, a lot of times that was because their duration didn't match, or their psychology didn't match the duration, right? And so that's really the equation we're solving for, which is unique to each person, right?
From a client perspective, I think the interest rate risk decision is a little bit more nuanced and really should focus on what they're trying to achieve out of their fixed income holdings, right? So we kind of think about it, stepping back, looking at the roles of fixed income, right? We think there's basically three. First, preserving capital, right? So, if you think about that, the risk that you see in fixed income, rates, it can be credit. So if you're looking, if you're prioritizing preserving capital, you're looking to sort of mitigate interest rate risk, mitigate credit risk, or both, right? So think short-term bond funds or something like that, serving that type of role. The second role is a diversification component to your stock holdings. We think something like the mainstream, like a core plus type product is one that serves that role best. The third portion is income, generating income. You're going to want to take corporate credit risk or high yield risk to sort of increase the level of income that you're getting. Now, how a client prioritizes those three roles should really drive how they allocate across fixed income. So as an example, let's just assume an investor says, you know what, I prioritize each the same. So you basically would say, hey, I'll own a core plus product, driven by how much risk you want to take. Maybe add some short-term bond fund to that to manage the overall level of interest rate risk, and sort of move on from there. So we really think about, from a client's perspective, is that how much duration you take in your portfolio is really a key component of how you're managing risks. And what we're looking to do is deliver in our products, the level of interest rate risk consistent with the product, so that you can have confidence when you build portfolios that you're getting the level of interest rate risk that you want.
Yeah, really, it's just, we're always talking about different buckets. Give them assignments, and then let those buckets perform and behave with the way in which they were designed at that time when it gets really hard.
I think too, there was, going back to 2022, I think that there was a pretty material sort of misunderstanding of interest rate risk. And so if you think about the largest benchmark in the space, the Bloomberg US aggregate, right? It's the level of interest rate risk taken in that product varies considerably over time, right? So from basically 1990 to 2008, it was probably average 4.5 years. It continually extended from 2008, 2009, and peaked out at the end of 2021 at 6.8 years, right? So what that means is that if there's a 1% increase in rates, on average, roughly the bond price will decline 6.8%, as opposed if it held the average level of interest rate risk that it had pre-GFC, it would have only gone down 4.5%, right? So it's a material sort of magnitude of change. So we think that just simply relying on by itself, core plus or whatever, that really manage interest rate risk relative to the ag, might not meet the risk tolerance with regards to interest rate risk, because the interest rate risk taken in the benchmark has varied considerably over time.
Yeah, and has gone up.
Yeah, it's gone up. So then it's come down a little bit, and it's really the components of it. It changes over time. So there's a lot of different drops.
A lot of moving parts.
But I think I think there were a lot of clients that was a surprise to them, right? When rates moved, that the level of interest rate risk they were taking was might have been higher than they had.
That was maybe baked into their mental model, at least.
Sure, absolutely.
So just a couple more questions for you, and I really, really appreciate you taking the time. To a little bit of a different change of pace, but this is another conversation we've been having with clients, and so I wanted to get your thoughts on it, given that you're in this world, at the deepest levels, in the weeds every day. But a lot of headlines back in the fall about U.S. government debt, just the sheer magnitude of it. The interest cost has obviously gone up as interest rates have gone up, because most of the debt has been shorter term. We even saw another downgrade, which we saw back in 2011. So people have discussed this for decades, right? Like the debt clock was up in New York, I think starting in the 80s, maybe. So it's always been a thing, but as markets evolve, so do the types of risks the market decides to focus on at different periods. When it comes to bonds today, how do you think about that? The risk of just the sheer volume of government debt, and credit risk in general, just because there's so much more debt than there was, even a short time ago.
Sure. Well, let me first define what we think are the two sort of primary risks in the fixed income markets, right? One is interest rate risk, right, which we talk a lot about today. So this is basically
right.
How much do bond prices move for any given level of interest rate movement? The next risk is credit risk. So this primarily, in our view, is like the risk of not getting paid back, right? So either that is the issuer of the bonds just doesn't generate enough cash or can't raise debt to sort of pay you back or pay the interest on the bonds.
Okay.
As a subcomponent of that credit risk, there's like credit spread risk, where credit spreads are the incremental yield you earn above treasury bonds to take credit risk, right? So you'll have bond prices move based on how credit spreads are moving. However, those tend to they move around quite a bit. And the real permanent risk is the non-repayment risk from credit. So now what you're talking about, there's been a primary, the treasury component is really an interest rate risk story. Although we've heard a lot of people start to talk about it being a credit risk story. So let me sort of dive a little bit into that. So let's think about the risk that we're seeing, obviously from higher rates, greater fiscal deficits, increasing the interest burden, right? Becomes a larger portion of the budget, less sort of space in which the government to sort of operate, because more of the budget is obviously being
just crowding out spending,
and it's crowding out other types of fiscal spending. So, and then obviously part of the narrative was that, well, this is going to increase rates permanently. This is going, the amount of bonds that we have to issue is going to weigh on rates as well. I would say that narrative, at least in the near term, peaked in October. Rates have fallen considerably since then. Those voices have kind of gone silent. And I really...
No, they're yelling about something else.
view that there's folks that come out and talk about that all the time. They're saying the same thing all the time, hoping they'll eventually be right. And they get airtime when it's sort of convenient for them to get airtime. So our view at that time was really that the higher yields in October were driven by the market just trying to price in how long rates are going to be, how high are they going to be, and for how long. That narrative has changed and rates have promptly come down.
Yeah, it's that battle of narratives again. That's what this is.
That in the near term is the primary driver of how rates are moving. Now, not trying to say that the higher debt burden doesn't matter. It does. I think there are longer term consequences for that. I don't know when those happen, but I think longer term having the not necessarily the magnitude of the debt, but the level of deficit spending, the debt relative to GDP, those are all concerns. And certainly, I think over the long term, they may have some impact on treasury yields. However, I don't think it's the primary driver of the yield changes that we're seeing now. And I think the narrative behind it is largely just,
political.
I'll listen to that type of thing, right?
Yeah.
So now with regards to credit risk, is there credit risk in treasuries? I think the short answer is no, right? All the risks to repayment that we've seen have been unforced errors every single time. It's debt ceiling, brinksmanship, government shutdowns, neither of which has had any impact on the long-term fiscal trends, right? So if you really were concerned about those issues, the sort of negative long-term fiscal trends, and you should probably spend your time solving those sort of issues, right? So really any sort of repayment risk is going to be driven by unforced error.
Theatrics.
So, I think that treasury bonds have the same risk that they always have, right? That it's sort of similar to other bonds. Their level of interest rate risks and always, as with anything that you hold, the risk of inflation eating away at returns. However, what we're seeing now is rates are higher, that real rates are positive, meaning rates are higher than CPI, right? So that's not where we stand right now. So I think just I get it's a concern. It's a constant drumbeat on the news, but it's not something I think that is a near-term concern. But it's clearly, I think, a problem that needs to be solved over a longer time period.
So the answer you just gave, which was thoughtful, nuanced, had multiple parts to it, right? When you get to complex subject matter like the treasury market and U.S. government debt and fiscal policy, there are a lot of things that one should consider if you want to have an intelligent conversation. The way the world has gone, at least, digitally, and in terms of how and where we get our information, we have gone the opposite of that. So it's black and white, it's sound bites, right? Whether it's politicians or people on Wall Street, frankly, where whatever their incentives may be to sell something or to get a message across or to get more followers, like we got to break all these things down into a bumper sticker. So we're always trying to combat for both ourselves, but also for our clients in terms of making decisions. Like, how do you remain a long-term rational thinker in what is increasingly, a short-term, almost schizophrenic environment with which we receive the information every day?
That's the yes, you explained the environment very well. I think for us, focusing on our process.
Yep.
Right. We know what works. We've been doing it a long time. Let's focus on that. Everything else is noise. And I'm just going to give you an example. Like, folks on my team we read all kinds of stuff, right? And things send it to me. And most of the time some of the times I respond is like, I don't really care what this person says, because whose opinion I care about are those that have capital on the line.
Skin in the game. Yep.
Or in this building, right? So whose opinion I really care about as far as what we should do with our portfolios. Those people are on my team in this building, own our funds, do our research, have capital on the line, right? So I'm more concerned about folks who are aligned with our process, who have their own skin in the game. What do they think we should do, as opposed to what anyone is saying on?
I love that.
Whatever, right? So my advice is, I'll just say, because this is what I do. I do not watch not just any financial news, but no news on TV, none, zero, right? And I don't do that because, one, it's depressing. I mean, who wants to do that, right? And they're not incentivized. Their incentives are not aligned with mine, right?
Right.
My focus is on understanding our process, focusing on our team, doing the best job we can for our clients. And none of that involves caring about what anyone says on TV or in their latest blog post or what the latest doomsayer is saying. That is irrelevant to me, right? So how it applies to your clients is, you have a plan. You set them up with a plan of what they should do with their investments. Stick with the plan. And that's your best probability, I think, for long-term success. That's what we've seen with our products. And I think it's has the side benefit of being substantially better for your mental health.
That's for sure. That's great. So two more questions, and I promise this time it's just two, but this has been so great, Jim. So we're in such an interesting moment, I think, to have you here and in markets in general, right? Like, may we live in interesting times. We've talked about a lot of the reasons why, we're in the heart of some interesting times today. What, in your view, is one question all investors should be asking themselves and really getting their arms around for their own personal situations in the current environment? And that maybe the answer is always the same. And, do I have a process in some of the things you mentioned? But what in this moment should investors be thinking about? Whether you're a 30-something starting a family and trying to build wealth, or maybe, you're in the other chapter, you're trying to preserve wealth, you're trying to enjoy that nest egg that you've built.
Well, I'm afraid my answer might be unsatisfying. I think that the question they should be asking themselves is, Are they comfortable with their plan? Does it meet their risk tolerance? And can they stick to it regardless of the market environment, right? That's the most important question. Sticking to a reasonable plan doesn't need to be the perfect plan. This needs to be a reasonable plan over time. At least my personal view is it gives them the best chance for achieving their goals over the long term. I think it's frankly a waste of time for almost any individual to try to read the tea leaves of where the market is going, what rates are doing. I get it. And to sort of succumb to the comfort of someone telling you this is going to happen or that's going to happen. Right. I think that's, I don't think that helps achieve your long-term goals. So what I do is obviously I spend all day looking into markets, trying to do what's, build our fixed income portfolios. But I don't, when I try to do a lot of reading outside of that to get a sort of greater view of the world. I read a lot of history books and things like that, just to sort of really to look at things from a broader view, a different view. So you'll see me spending very little time in the sort of evening, reading market news. How can I learn more about something else that may help me think about things differently or drive long-term success for my clients or help me lead my team or do all those different types of things? I kind of view that as a much better use of my time than.
Yeah. Finding those things that don't change every day, like markets, and then trying to understand if they can apply to other areas of life, can go a long way. And like you said, it's also just way more enjoyable.
For sure. There's no doubt about it.
So my last question, and this is something I have asked every guest so far on the podcast, and I'm really interested to hear yours, given your line of work and the career path you've taken. But what piece of advice would you give to your 22-year-old self today, given all you've experienced up to this point?
Yeah, that's a great question. I actually thought quite a bit about it. I think the biggest advice I would give to myself is to focus on the big rocks, right? To focus on my family, my wife, my daughter, my parents, my brother, spending time with them. It's making sure that they're a priority in my life. I think that's a huge thing. And it just, at the stage of my life, my parents they're getting much older. My daughter's about to flee the nest. And I'm like, man, did I spend enough time with her? Did I do it? Like, those are the things that are most important. And just focusing on that. When you're 22, I was very much focused on my career in the Marine Corps, preparing myself for the future, doing all those things. And it kind of ends up what really brings you joy and value through your whole life is sort of focusing on the big things. And for me, it's my family. For me, it's my health, focusing on my health. I spend a lot of time trying to stay healthy. I kind of want to, keep being able to do the things that I like to do. I like to get outside. I like to ride my mountain bike. I like to do all those things. And I'm still doing them now. And I'd like to be doing them 10 or 20 years from now. I think what I valued in my career is what I look back on is the people that I've worked with, building a relationship with them, focusing on that. Right. And I think as, each stage of my career, each place that I've been, I focus more and more on that. Right. So there's people who I worked with 15, 20 years ago who I still keep in touch with. I still consider friends. I still text back and forth all the time with them. And I think as far as bringing, joy to your work life, is sort of doing things like that and making it important. Right. And I think over my career, that's sort of ebbed and flowed. And I think at the stage that I'm at now, I'm valuing that as really important. Because those are the folks I reach out to now. Hey, how do you think about this? What would you do in this situation? Just really having, building that trust over time to be able to have conversations with them to sort of help me out in my current job. And that extends to like what their kids are doing, all those sort of things. So to me, focusing on those big rocks, your family, your health, the relationships you build over your career, just focusing on those things.
So great. Jim, thank you very much for the time today. That was a tremendous answer. I know, I'm going to get I got a lot out of myself, and I know listeners will too. So thank you for the time today. And I appreciate you coming on and sharing your thoughts with us.
No, this was awesome. Hopefully it's helps your clients and helps you guys. It was a whole lot of fun. Thank you.
Thanks so much, Jim. The information on this podcast was created by Alliance Wealth Advisors and published for informational purposes only. The guest on this episode was not a client at the time of this interview and did not receive any compensation. For more information, please visit alliancewealthadvisors.com. The information and content on this podcast is created and authored by Alliance Wealth Advisors and is published and provided for informational and entertainment purposes only. None of the information contained in this podcast constitutes a recommendation that any particular security, portfolio, or securities, transaction, or investment strategy is suitable for any specific person. Thank you for listening.